Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Wayne Courageous. Now, Wayne is the founder and managing principal of CREI Partners, a real estate investment firm that focuses on both multifamily investments as well as boat and RV storage. His group currently has assets in Texas, Louisiana, and Alabama. And so, guys, without further ado, I'd like to welcome Wayne Courageous to the show. Wayne,
Thanks
my
for
friend, how
having me
you doing
on.
today?
I appreciate you having me on, Kevin. Looking forward
Yeah,
to this.
excited to have you here. Excited to talk shop and just to pull back the curtain and learn a little bit more about yourself, your background, and then more specifically, we'll dive into some of the asset classes that you guys are focusing on today. But with that, let's back it up a little bit. I gave you a fairly brief introduction. I know there's a lot more to your story than what I shared, and so I would kindly ask that you take a few minutes, Wayne, tell us a little more about yourself, your background, and then how you found your way into real estate.
Yeah, so I'll start off, on my personal side. I've got a wife. We've been married about 15 years, and then I have three kids, Hunter, Lily, and Emma. They range from 12, 11, and 10. Actually, my son Hunter he's going to turn 13 next week, and he's going to start underwriting and learning the real estate business at the young age of 13. So I'm so excited
Oh, I
to
love it.
start that. Yeah, that was something that I'm like, so all my kids, when they turn 13, they're gonna, and it's probably gonna be 3 to 5 hours a week, not gonna be crazy, but I'm super excited about that. And but anyway, but I started my real estate career actually in the Marine Corps. So 2003 to 2007 is when I was in the Marine Corps. I bought my first single family rental home when I was 19. And then when I got out of the Marine Corps, I joined CBRE, a big commercial real estate firm, where I was there with them about 16 years. And so my whole background, my whole life has been in commercial real estate. I know nothing different. I have the bug of commercial real estate and just grateful for that. And then in 2019, I started CREI Partners while working for CBRE, and they knew about it. It was all open and transparent. My 9 to 5 paid for my 5 to 9 until it got to a point where it was really hard for me to do both. I didn't leave my W-2 because I disliked what I was doing because it was in commercial real estate. I just couldn't do both well because our investment company had gotten to a point where, it got to a size where I needed to go all in or take a huge bet on myself to go all
Yeah.
in and do this. So, and then since then we've added on to our team. We have, a full-time senior portfolio manager. We have a full-time investor relations person as well. So it's been exciting for me to, focus more on what I enjoy most, and that's acquisitions and development, and then have a team that can support the asset management aspect and of course investor relations and marketing, of course. But
Yeah.
yeah, that was just, high level family and how where we are
Okay.
today.
Okay. Fantastic. I appreciate that. So with CBRE, just curious, what was your role there over the years? You said
Yeah,
16 years
so
that you were there, correct?
16 years. So I was always in property management. I focused heavily on the operations side. I started in Washington, D.C. On a portfolio for Clark Enterprises, and it was all office. I think they had one industrial that I helped manage, and then every few years I was getting promoted, an opportunity to lead and take on more opportunities. But it was fantastic because I really do enjoy the operations of the asset and sort of seeing the full cycles. Especially if a property is just purchased and you've got this business plan and executing the business plan and seeing it through, and then seeing the life cycle of it, either through a refinance or through a sell. And so that was my life for 16 years. I was a director in Houston for property management. And so that really gave me a big understanding of asset management and seeing it from the client side and thinking like an owner. And
Mm-hmm.
so, that translated well when we were starting to buy our own properties and working with third-party managers to, execute the business plan while we were more heavily on asset management and being more strategic thinking, for our portfolio. So
Yeah.
yeah, that's what I did, and you know, was really a great. They always took care of me, so it was a bummer. Like I remember, I drove to work one morning, and I called my wife, and I was like, if I go all in on our business and we lose everything, are we still good? She's like, yes. Because I mean, I'm so risk adverse. I mean, real estate investing is already
Yeah.
risky, and people are like, you're not risk adverse, you do real estate. But really, I mean, leaving that comfort of a W-2. But I had built, at that point, built a business and, your podcast is about cash flow, built a business where there was cash flow coming in and, and, I think it was the right thing to do for my investors and then,
Yeah.
for our family.
Okay. So what year was that you took the leap of faith finally? I know I
It
think you
was
said
July 2023.
okay. Okay. Fantastic.
Yeah.
So fairly recent. Well, good deal. And I think you had mentioned you just got to the point to where you just didn't have time to do both, right? Like you can't be great at all things. And so
Yeah.
finally took the leap of faith. Your wife was in full support of it, which is amazing. So it's always good to have a supportive partner by your side. Very difficult to do it otherwise. So kudos to you for doing that and just jumping in with both feet. So curious, multifamily assets, understand the premise there and the reasons for that. Obviously, we have a massive shortage of affordable housing throughout the entirety of the country, as well as many of the markets that you guys are invested in. But curious to talk a little bit more about boat and RV storage.
Yeah.
Just what attracted you to that asset class? I mean, obviously it's got some fairly unique nuances when compared to kind of the demand drivers for multifamily, right? Very very different business model in its entirety. And so I guess just curious. I guess first and foremost, boat and RV. Why
Yep.
that asset class?
Yeah. So, I mean, you mentioned multifamily. So multifamily is our bread and butter. That
Yep.
is, majority of our portfolio is multifamily. Um, Reason why I even got into boat and RV, and I'll also add business storage because what we niche on are 20 by 50 storage units, fully enclosed storage units that have, LED power, like a 110 volt, power outlet, 30 amp or 50 amp connections in the back. And, we, being in Texas, we love to camp, but it's really hot. So when my kids were super young, we bought our first pop-up camper. And then we, eventually moved into our travel trailer that we have now, that we, enjoy weekend trips or, spring break or summer. And so like I would always be like in a KOA or a Jellystone or something where, I'd be next to the $500,000 RV and I'd be in my $30,000 camper, which I love my camper, but man, some of these RVs are just gorgeous.
Yeah.
And I was like, man, so I was like, you see them on the road, but you don't really see them stored at their house, right? They're not, you can't store it in their garage in many cases or, on their driveway because of HOA. And so I had a really good partner, a really good friend of mine, Huntsville, Alabama. His name is Stuart Heath. He reached out to me and he's like, hey, we're doing this RV boat storage deal in Huntsville, Alabama. Would you be interested in partnering? And typically we don't partner for outside deals. We typically do, our own deals as lead sponsor. But I was just so intrigued and I trusted him and he's someone that I just love doing business with. So I went out there, toured the facility, and yeah, it's definitely a niche. Now, after we bought it, Kevin, a few months later, we were changing out locks and changing out leases to the new ownership. And I was there and I was getting to know the customers of like, why do y'all need 1,000 square feet, 20 by 50 with like these 14-foot by 14-foot roll-up doors? And what really excited me was not only were like the high-end RVs and boats, but a lot of the businesses. So anybody that needed um, inventory storage for mechanical, electrical, plumbing, disaster
Hmm.
recovery, generators, they all need storage and may not necessarily need like flex warehouse space where they have an office and then, some storage. They just need a place where they can roll into, get their supplies or other employees get their supplies and leave. So I was just meeting a lot of those people. And I was like, man, these people, they need this, these businesses need this space, which is an extension of their business. So they're less likely to have turnover
Hmm.
and it's a tax write-off. It's an extension of their business. So when I came back to Bryan College Station, I was driving home, and this is a very much of an entrepreneurial real estate investing, especially in my world. It's very entrepreneurial. So I saw this niche. I'm driving home back from the airport looking for land, and I found land right off Highway 6 here in Bryan, and went to the steel building place. I was like, and I'm telling you the full story because I think anybody listening in from a real estate active investing, there's all these processes that goes place. But went to the neighbor, Mueller Steel building. I was like, y'all know who owns this? And he's like, yes. They took, so I went to the one place and they're like, oh, you need to go to this other place, to the other place. Anyway, I found this owner and we did a seller financing deal, built 72 units, all 20 by 50. That took about 9 months to build. And we're about 40% leased up. And so we're pushed on that. So that will be our second 20 by 50 storage facility. We're looking for other land. The reason why I like it, and I'm talking a lot here, but when you compare it to like multifamily, and I love multifamily, but you deal with a lot of emotions with
Mhm.
multifamily. It's someone's home. With storage, there's no emotions. It's like you pay your rent. If you don't pay your rent on the 5th of the month, the gate locks you out, and there's no eviction process. It's just a lot easier from that standpoint. It's auto debited cards. Like on the first of the month, it charges the card. Everything is automated through the system. All short-term leases, 30 days. So I've terminated leases where like they weren't a good fit for our storage facility. They worked on cars outside their units and just made a mess. Well, I gave them a notice and I didn't have to wait a year or an eviction process. I also like having that the expense ratio. Say, in multifamily, I really strive to, get our expense ratio 54% or less in Texas because of insurance and taxes. It's a little on the higher side of 54% or so. But on, boat and RV business storage that I'm doing, our expense ratio is like 32%. And
Mhm.
so there's a lot of cash flow and opportunities to, really just be in this niche market. So we're going to continue growing. I have people who have wanted to raise money and other investors who's like, hey, I want to do more. My thing is like, it goes back to the risk, being sort of a risk adverse, is like, let's do this one project, let's get it stabilized, and which we are, and then let's go to the next, and then maybe even do a portfolio at some point.
Okay. Yeah, good deal. So I think you said 72 units on the one
Yeah,
that
for
you
this
said.
particular one, 72
Okay.
units. Our one in
So
Huntsville, Alabama, that was 125 units.
okay. Well, let's I guess use the one this one as a case study here. I think you said you're about 40% leased up at present time. Is that within your projections? Is that better than or worse than of what you guys projected?
I anticipated eight per, so we opened up fully in July, and my anticipation was eight per month. And what I've seen is it's been closer to four or five a month.
Okay.
We have enough reserves and such, but we've done a total of, I think we've done a total of like 39, 40 units of leased. But where we are today, so we had, some move outs. So
Yeah.
being in College Town, a lot of the high-end RVs came in from out of market, out of the area for the football season. And so they leased up, for, 4 or 5 months or 4 months. And then football season left, and now they're taking their RVs back home. And so those people will likely come back to us, but really the business more so is finding businesses. And yeah, we have the RVs and we do have, people with boats. But this is 1,000 square feet, 20 by 50. If you look at majority of the storage, even just the height of the door, maybe 8, 10 feet at most. Well, these large RVs that, drive around are 13 feet, 6 inches. Uh,
Mhm.
once you add the HVAC and everything in. So, there's not, if you want a enclosed storage space, for us in this market in particular, there's really nothing for them.
Sure, sure. What's the average? Just curious. I mean, I know it's going to vary market to market, but what's the average rent on a monthly basis for one of those 1,000 square foot units?
Yeah, so what we charge is 750 a month here in Bryan College Station. So 75 cents a square foot. Our Grace space, we've got that up to 650, but we bought that, and kudos to Stuart and the team there. I mean, they're really the boots on the ground. So I definitely give credit where due. The rents when we bought it was 375, so they've raised it almost $300 in a
Mhm.
2 year period and have kept literally 100% occupancy. And the people that have left, there's always a waiting list. So that seeing how successful that is. Now we're also there's also other land behind it that was part of the initial transaction, and the plan is to move forward and is moving forward with adding another 70 units there. Um, but like once you get it up and running and those people in, I mean, between their inventory and they tend to stay. And so I still am a believer that, we will have some turnover, but for the most part, you don't have the guy that's doing a 10 by 10 or a, 20 by 10 or whatever, they're likely to move in 6 months or so once their house is built or when they're, it's a very temporary storage where we're
Sure.
seeing it more of a long term.
Is there I guess just determining like what the feasibility study looks like to to determine the demand. Like I think it sounds like if I'm gathering this correctly from you, like your ideal customer is someone that needs additional storage for their business. Like that, it seems like they probably are better suited for a long-term stay than that of
Yeah.
maybe someone that's got a an A-class RV or a boat or a camper or something along those lines. Is that an accurate statement?
It is. And
Okay.
so on the feasibility piece, right now we're going to be developing a hotel in the area. So we did a feasibility study based on rooms and, what the demand is. And in self-storage, it makes sense too, because, you know, uh, self-storage in particular, I'm not a big fan of personally because there's so many self-storage facilities, and they all are competing right down the road on price point and everything else. And so doing a feasibility study for regular self-storage definitely makes sense. Houses and, growth areas, and then obviously what already is there in supply. These 20 by 50 storage, I personally didn't do a feasibility study
Mhm.
in a sense of a formal study, but I did go to the competition to find, what other offerings are there? So there are other storage facilities that do have RV parking, but the drive lanes are maybe 30, 40 feet, where our drive lanes are 60 feet. If you're driving a bus, motorhome, and it's a 44-foot RV, you're going to need that extra 15, 20 feet to, back your RV in. Or like a lot of the units are gravel, or a lot of the facilities had gravel. Well, if you have a 500,000 plus RV, you're not ideally driving on gravel where you
Sure.
don't have to. Or power, a lot of these units, they could park, but there's not like the 30 amp or 50 amp power or a gray black water dump station. So from my standpoint, going to see what the competition was doing and then seeing what their occupancy was, which was, high occupancy, um, I felt confident like, hey, we can build this right off the highway and get people. It's going to take longer than
Mhm.
say your normal self-storage, but I mean, I'm charging 750 a month. It's almost rent, right? And our expense ratio is 32%. So it's pretty high cash flow, once we get stabilized and
Yeah,
leased up.
fantastic. What type of debt's available for a project like this? And maybe I should ask as a part B question. Like, I guess as far as development, obviously I'm saying it's probably a local bank of some sort, and then, but more specifically, I think once it's stabilized, um, what are the best debt options that are out there for a project like this?
Yeah, so most of our multifamily, and I know we're talking about storage here, but there's different. For
Mhm.
multifamily, we typically do Fannie Freddie loans,
Sure.
right? But
Yep.
storage, alternative investments, and Fannie and Freddie with multifamily, there's a 30-year. Even on a HUD loan, we're doing a 150 unit multifamily development. That's a 42-year amortization. So
Hmm.
there's a reason why I love multifamily just from an
Yeah.
amortization standpoint,
Absolutely. No, it's best
right?
in
Fixed
class.
rate,
Same thing with
non-recourse.
mobile home parks. Yeah, we love
Yeah,
agency debt. So it's I know that it's and the reason why it's kind of the reason why I asked that question. It's a
yeah,
little trickier when you get into other asset classes. So, you've got CMBS that type of debt that's available, which is very cumbersome and it's nuanced. And then you've got bank, whether it be local, regional, or national banks, credit unions, things like that to work with. So, but
yeah.
Fannie and Freddie, yeah, like hands down, the
Those are
best in
great.
class. Yeah,
Yes.
I wish they lent on things outside of residential.
Yes, and that's where I was going with. So I wanted to tee it up with that to go to really your question.
Yeah.
With alternative investments outside multifamily, office, retail, storage, et cetera, community banks who know the market, who have the relationships, who typically like they want deposits too. So finding those relationships in
Mhm.
those banks. So that's what we did with this storage in particular. Veribank, I'll do a shout out to Veribank. They are absolutely incredible to work with. They quoted, now, mind you, we got this loan in 23 and markets were all over the place, right? And so I, as a sponsor, typically what you would do is like a construction loan, maybe it's a 2-year construction loan, and then at the end of the construction loan, you refinance it into permanent debt.
Mhm.
at that moment in time, what I was trying to do was like not play chicken with the markets and like, hey, let's do a construction loan that then goes to a permanent loan once we stabilize or once we have that 2 years. So what we did is a 2 year construction loan, and that was based on prime rate plus quarter basis points or 0.25%. And so that's, so fortunately for me and our investors, as the Fed has lowered, 25 basis points over the last several months, that has directly helped our construction loan because our loan was based on the prime rate.
Yeah.
So that's been helpful. I don't know if that's going to continue in 2025, but either way, that has helped us so far. Now, once the 2 years hits and once we hit a certain stabilization based on debt service coverage ratio of 1.25, then it goes into a permanent debt, and that permanent debt is 7 year treasuries plus 3%.
Got
So
it.
we should stabilize around 7.5 a quarter. We did most of your non-multifamily stuff, the amortization's like 20 years. On this, if I recall, we were able to do a 25-year amortization, which definitely
Hmm.
helps cash flow as well. So that's how we structured it. And again, local banking relationships has helped, and we'll continue, working, especially with Vera Bank here locally.
Yeah, no, good deal. I appreciate that additional insight there. So I guess, you know, curious as to the last 2 years have been incredibly challenging in many different ways. Curious, and it sounds like you guys have grown. You've hired some critical staff members to help you you'll continue building the company. And just I guess next 2 years, what does that look like? What's that roadmap look like for the organization?
Yeah. So with any market, we are buyers. We really believe that, they're really not making more dirt and high uh, trafficked areas. Maybe in some countries they're building new islands and stuff like that. But, in Houston, there's only so much land, or Austin, there's only so much land. And so, we are been continuing to buy. The last 2 years have been really great for us, and it's because we didn't put our head under the pillow and say there's no deals. If you have that mindset of there's no deals, and there's no deals. The deals that we have closed on, most recently was September of 24, was a loan assumption. It was a 3.82% fixed rate debt loan assumption that had another 5 years remaining. And so, and we bought that, say August 28th was closing date, and we did our first distribution in December. And so every quarter we'll be doing distributions because, the DSCR on it's like 1.6, and, it's just a good
Hmm.
cash flowing deal,
Yep.
that we were able to be creative and work our butts off to get the deal at a 3.82%. Prior to that, Kevin, we bought another property that was seller financing. Now that's really hard to do in our world because most people use the benefit of leverage. But in this case, it was a REIT who owned this land free and clear.
Hmm.
So a lot of times, like 1031s, I mean, they may own the property. So there are groups out there and properties that are, because of tax reasons, they own the property free and clear. There's no leverage, there's no U-bid or anything like that. So, and so we did a 6% fixed rate deal. So that's been the good. Now, if anybody on your show that invested in 22, 23 can look you in the eye and say they had no hard times, like that's BS. And so we had a one property we bought in 2022. So that's good. And luckily the whole portfolio is doing well, but I had one property, and, I always like to bring this up if you're okay with it. But, in
Sure.
2022, we bought a property, bridge debt, with a strong business plan of doing what a lot of other people were going to do, renovate units, increase rents, et cetera. And then, for us, we got hammered by interest rates and insurance and taxes and lower
Hmm.
rents and supply. I mean, it was just brutal. Where a lot of sponsors, I think, went wrong over the last couple of years is they didn't communicate to their investors. They weren't transparent to their lenders. They weren't, doing everything they could possibly to get through. And so that one property has aged me probably 20 years. I will never do a bridge debt again. But one of the great things is as of last week, we were able to modify that loan and get life So now it's turned from bridge to fixed rate. And so all that said, it's setting us up for the next couple of years because I feel like we've gone through the worst of the worst and we didn't quit. And, investors need to know you're not going to quit. You're going to stay transparent. You're going to fight through it. And so we haven't lost any investor capital. We've modified it. And then we have these other properties that we bought at extremely great values with fixed rate debt. And so we're going to continue doing that over the next couple of years, is finding opportunities. I'm bullish on development as well. So we have land out here in Bryan College Station. We're going to be doing 150 unit multifamily development. That will kick off in August. We'll also have a retail office development, and then we're also doing a hotel development. So all in this area will be a mixed use, different phases. And then we are constantly reaching out to off-market sellers who are potentially looking to sell, and then also building our broker relationship. So
Okay.
all that said, a lot going on, but we never
Yeah, that's
stopped during the last couple of years, even when things were tough on our portfolio with that one property. Um, I'm just proud of our team, and I can say I'm proud of myself too for fighting through
yeah.
and we're not over with it yet, but that modification is a huge win because a lot of lenders didn't believe in the sponsor group or didn't believe in the business plan for whatever reason and took the property back or traded that property to another sponsor where
Yeah.
all investor capital was lost. So anyway, some good
Yeah.
and bad of real estate investing, but I think it was just important to share the last couple of
No,
years.
I appreciate that. No, that's great feedback. I'm curious on the one deal that you I guess you had a loan modification done on.
Mhm.
Did you have to bring in mezz debt to help resolve that issue, or just
No, no,
curious
they
as to
were.
what the solution was?
Yeah, the solution was so May of 24, we went out to the lender. Well, when we did a capital call, nobody wants to hear capital
Yep.
calls. Nobody wants it, but I swallowed my pride and was like, hey, we need to do a capital call. So we did a capital call in January. Um, Understandably, a lot of capital calls were happening at the same time. A lot of people didn't want to put money in, feeling like, hey, you're putting bad money in after bad money. Understandable for us. It was our only deal that we had to do and hopefully never do it again. But so some people did bring it in, but we had cash flow until July. So we pretty much survived another 6 months, right? But in May, I had a call with the lender and I told them, like, out of transparency, it's like, hey, this is what's happening. This is what we're doing. This is, starting in July, we're not going to be able to hit our debt service. And so then come July, they were like, well, we can't really start modification of the loan until July or until you miss a payment, in essence. So I gave them a heads up. We missed our first payment in July. It took between July, now this is February. Was this February yet? Where are we?
Yep. We
Yeah,
are
man.
February 4th as we record this.
February 4th. So February 4th. So it took pretty much then until January 25 uh, for negotiations. Now, a lot of that reason, and we can have this huge conversation on it, but there was a lot of worse properties than what we had. So I mean, the banks are swamped with these type properties that, are struggling. So it took a long time. In the meantime, um, debt service wasn't being paid. They were paying operations. But in essence, what we negotiated was the several months that we did not pay goes onto the back end of the loan, right? So we're removing that. That clears us. It we did have a rate cap with our loan. We were able to sell that rate cap. So there was about $100,000 there. That $100,000 was put back in the operating bucket that we can use for cash flow purposes. I am proud of our team for being less than budget on CapEx. So we had about $500,000 that we did not spend because of CapEx. Now that 500,000, because it was bridge debt, was held with the lender, and that lender bucket, it wasn't meant for debt service, but we had that money is there because, we bid the process. We did our, fiduciary job of doing the job at the less possible cost as we can. So we had that bucket of money. So all that said, they looked at the bucket of the monies, they looked at our business plan, they came to Houston, they met with our management company, they met with myself. And anyway, so that's what we did. We did a fixed rate debt, 6%, got out of the bridge loan. There's monies in there to help in the interim while we're renovating and doing, turning the property around. but it's not, this is why, passive investors, you know, should stay passive investors because this is not for the weak-minded. I think a lot of real estate people that we know, Kevin, or have known are no longer in real estate investing. Like there were a lot of years that people didn't have to do anything and made good money. Well, that's not normally real estate.
Yeah.
There's going to be ups and downs. But just talking through it and realizing, the grit. It's one of my core values with our company, is grit. And that grit was not a core value 2 years ago. Like that grit,
Yeah.
like that is a real thing. And so, our investors, and what's really cool, Kevin, and to me, it's a blessing, and I get chill bumps. Uh, but like we've done other capital raises, and those people that were on that deal that suffered reinvested in other deals, and in some cases did more. And it just because they knew like we're always going to communicate, we're always going to be transparent. And also they did other deals where they saw lots of cash flow, and so
Yeah.
give me on the one. But ultimately, we're not done, and we're going to continue pushing forward. So
Yeah, that's great. No, I mean, I think you make some really valid points there. I mean, even speaking to just kind of separating the wheat from the chaff, as it relates to the last couple of years, it's tough for a lot of groups out there, and it was very easy making money for many years. You could have been a horrible sponsor. When cap rates are continually compressing year after year and rates are going down, you can have a business plan, did a really horrific job executing on it, and still look like a genius in the back end, and probably a shorter period of time than what you had originally projected, right? And so I think a lot of that was happening, and kind of the same thing. I had the luxury of living through '08. Had quite a big portfolio going into '08, and lost pretty much all of it, right? And had to rebuild again over the next couple of years, and learned a lot through that experience. But I had a lot of folks I knew that were in the industry that lost a lot as well, if not everything, and found new paths of work, right? Went to a different career, did something else entirely different than real estate because it was just too difficult for them to pull their bootstraps up and continue marching forward, And again, it's good. It's always good to have these points in the cycle where it helps filter out, those that really weren't really cut out for it. Not necessarily even just real estate, but just being an entrepreneur. I think that it's entrepreneurs are cut from a very unique fabric, and you either are one or you're not. I don't know if it's necessarily something that could be learned. Maybe different aspects of it can be, but the grit piece, I think you just inherently have it or you don't.
yeah.
And I think it shows up at different parts of your life. And so no, all good points there, and just glad to hear that you guys were able to push through that challenging deal. And obviously, it's still not maybe completely out of the woods yet, but ultimately it's going in the right direction. And since you got the right team behind you and the right focus and business model in place, so kudos to you, buddy, for just again, persevering through it, and because I know it can be quite challenging. And with that, Wayne, appreciate your time coming on the show. And for folks that want to learn a little bit more about you and your organization, maybe reach out. Be privy to any new developments or opportunities that you have coming up. Where's the best place to track you down?
Yeah, so CREIPartners.com is our website. But what I tell investors, and they're doing this through your podcast and other forums, is that it's getting educated. So we did a free passive investor coaching program, passiveinvestorcoaching.com. And I have about like 8 hours of content of how to analyze a deal, how to analyze a sponsor, really the A to Z of passive investing. And so the big piece on that is making sure people are educated for and feeling confident for when they start passive investing. So definitely encourage listeners to go to there. They can reach out to me directly at wayne@CREIPartners.com. Again, wayne@CREIPartners.com. But Kevin, thanks so much for having me on. And obviously I'll share this with my network too, so they
Yeah,
can learn more about you as well. So I'm grateful for the
absolutely.
opportunity.
It was a pleasure having you, my friend. And guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.